stock A and B. Now, but very often, you receive your unit trust. When they send you a flyer, what do they do? Now, I'm sure nowadays most of the fund managers, when you're investing in funds, right, and they manage your funds, nowadays they're more transparent. They will tell you exactly what they invest. But they won't tell you which share, but they will tell you at least their asset allocation. They will tell you how much money I put in share, portfolio of share. How much money I put in treasury bills. Alright, so most fund managers will state that the composition of the investment. If you are very frightened of risk, then most people will buy those funds put more money in treasury bills. But I also tell you those fund managers who put 90% of the money in treasury bills, they should not be fund managers. Because you know what? You pay them such a high management fee to buy all these. Who also know the buy? These are risky. Of course, what are return? No risk, no return. Right. You buy treasury bill. How much is the return? 1.3% interest rate. Not much better than the bank is from 2. Okay, so treasury bill is the lowest return. Now I think you buy treasury bill mostly 1% return. Now why? You are risk free. So what type of return you get? Right. So funds that put most of their money in treasury bill, this fund manager is actually not a manager. Right. He's just so risk averse. He did nothing. Just collect your management fee. So most of the fund devotees, at least either they are 20% or 30% in T-bill, or 20%, 30% in bonds, and 50% in stocks. Now these are higher risk, but you get higher return. Right. So fund managers' skills are mostly in managing this high return. But that's not easy. Managing stocks is very fast. Managing bonds quite stable, except in volatile time. Now this volatile time like this, then bonds are really hard to manage. Because now a lot of bonds now we are playing on yield curve, and it's very dangerous because now playing bonds, very likely to lose money. I think you already studied in the year 1 that the price of a bond will start to fall if interest rate starts to go up. Right, so now everyone knows that interest rate will go up for sure. It's only a question of time, right, which is very soon. Right, once the US central bank stops printing money, the US interest rate will start rising. Right, you should know why, because printing money means what? They are increasing the money supply. Right, and they print money for what? To buy bonds. Every month they buy $85 million worth of bonds in the market. But what's the meaning of buying bonds? Buying bonds means increasing the money supply, right? That's why US interest rate is historically low. Now once they stop buying bonds, so bonds will start going up, right? Once they stop buying bonds, so the money supply will fall, interest rate will start to go up. Now bonds are very vulnerable to interest rate. So once interest rate go up, the price will come down. You see, interest rate has not risen yet. The stock market is always forward looking. 6 months to one year ahead. Everyone expects the Federal Reserve to taper, to gradually stop printing, stop buying bonds. And so of course interest rate will go up. So once interest rate go up, what happens to the price of bond? All will fall. So before it even happened, if you look at a lot of Asia bond, right, emerging economies, the bond price already corrected more than 50%. The price will start coming down. So buying bonds in normal time is okay. Right? Why? Because you get fixed income. Every year, if you buy a bond, right? I think it's not that something. Right? You all know what bonds are, right? You get your fixed interest. $1,000 bond. Every year, let's say they pay you 10%, you get $100 every year, fixed for sure. Okay, but of course, if the price of the bond collapses, you go here and buy, your return is even higher, right? Because the bond coupon rate will change. matter how, they have to pay you this. So the bond, the par value is, to make things simple, $1,000. They borrow $1,000 from you, they pay you a bond interest rate of 10%. So every year they pay you 100. Now, of course, if the price drop to $500, your return will not be 10%. Because when you buy this bond, you still get $100, right? This one for sure every year they will pay you. You still get $100. When the price drops to 500, your return is how much? 20%. Understand? So bonds, once they start trading in the market, some go until very low. Of course, you want 80%, you go buy risk bonds. Now, from 1,000, the risk bond now drops to about $100. Almost everything is $1,000.